What do Russia, Zimbabwe, and Venezuela all have in common? They all have leaders who thought that recklessly printing money was a good idea. In the end, it always results in pure chaos. That's the path of hyperinflation that Putin has now set Russia on.
Inflation.
We can't just print money. It's basic economy, and history tells us this with examples.
And Venezuela's government hasn't been able to even print currency fast enough to keep up with inflation.
The Zimbabwe dollar is virtually worthless because inflation has skyrocketed.
And even with these examples, Putin keep on printing money. So how will this end? Will it end with Putin's downfall? Or will it end with fall of Russian Federation?
With the Russian economy facing imminent collapse, Putin has just decided to create more money out of thin air as a desperate move to buy more time. At this point, it isn't just about building a stronger or richer country, it's about survival through deception. It's about keeping his government running, his war going, and his people calm under crushing economic pressure. What he has chosen to ignore are the very real dangers that flooding unbacked currency into the economy has. The same dangers that saw Zimbabweans buying a single loaf of bread for over $2 billion less than 2 decades ago. Today, we'll discuss how Russia has started creating trillions of rubles from nothing, why this fix will backfire badly, and how it can end up affecting not just the Russians, but you too. Every ruble he prints buys him more time and robs ordinary Russians of their future. If you think this needs to be heard before it's too late, hit like and subscribe. It helps push this story past the algorithm and past the Kremlin's silence. Now, before we dive into the money printing details, let's just briefly go over what has led Putin to this position. To start with, it's no secret that Russia's economy isn't just struggling, it's suffocating. Sanctions have slammed the door on global trade, cutting off critical tech, foreign capital, and access to Western markets. Factories stall without parts. Export deals crumble. Even allies like China and India can't plug the hole, not when discounts and shipping costs devour profits. Oil, once the golden artery of Russia's budget, is bleeding out. Brent crude hovers below break-even levels, and Urals crude sells at a painful discount. Revenues have plunged around 20 to 27% in recent months since last year, with July alone showing a 27% drop year over year to about 787 billion rubles. Europe has all but abandoned Russian oil, and new buyers like China demand somewhat unreasonable bargains. Meanwhile, the war in Ukraine is a financial black hole. Russia's 2025 military budget has hit a post-Soviet record, over 13 trillion rubles. Recruiting, equipment, logistics, and casualty payouts are draining the treasury. Millions of workers are gone, pulled into battle or fleeing the country. Factories, farms, and storefronts are left gasping. And now reserves are running low. The National Wealth Fund, Russia's emergency cushion, is shrinking fast and is now down to barely $160 billion, with only about $48.3 billion of that being liquid. On top of that, the government plans to pull $16 billion this year alone. No doubt that will result in the budget deficit climbing. So with traditional revenue streams drying up and costs soaring, the Kremlin is cornered. And when you're out of money, but still need to fund a war, there's one lever left to pull: to create money. Lots of money. That's exactly what Russia has chosen to do. So how does Russia create this money? There are 2 methods that Russia is using. The first is not about firing up old printing presses, though the effect is similar. Let me walk you through the process. The government sells bonds, which, simply put, are promises to pay back money later with interest. Banks buy these bonds, but they often use loans from the central bank to do it. The central bank creates this money digitally, adding it to the economy without new goods or growth to back it up. It's like writing a check you hope someone else will cover someday. In the first half of 2025, the Ministry of Finance sold bonds worth 1.8 trillion rubles, mostly to banks backed by the central bank. The total injection for 2025 is estimated at 13 to 15 trillion rubles, mainly to fund the war and to plug budget gaps. They don't call it printing outright. Officials use terms like financing or budget support, because admitting they're creating money could spark fear. If people or markets lose trust in the ruble, it could crash. So they dress it up as normal bond sales to keep things calm. But the numbers tell the truth. The money supply grew 19.2% from January of 2024 to January of 2025. And by May, it was still up by 15.4% year over year. This is money creation, plain and simple. And it's all that is propping up Russia for now. What's also interesting is that recent rumors suggest that Russia might be about to print a huge amount of actual cash, not just digital money, but real ruble banknotes. That leads us to the second and more straightforward method, that Russia is executing its economic suicidal ploy. Leaked documents, reportedly hacked by Ukrainian groups, claim that Elvira Nebyulina, head of Russia's central bank, gave the green light to print 15 trillion rubles over just 3 months. That's more than a third of Russia's yearly budget. The order was allegedly sent to Goznak, the government agency that prints money. For context, Russia typically prints only about $5 to $10 billion worth of cash per year, and its entire economy is valued at around $2 trillion in GDP. Printing 15 trillion rubles, which equals roughly 165 billion USD, would nearly double the country's total amount of physical cash in circulation. If this is true, it means Russia isn't just creating money behind the scenes, it's firing up the printing presses in a big way. Experts worry this could make prices rise even faster and further weaken the ruble. The central bank hasn't confirmed the leak, but the details are causing a stir. It's a sign that Russia might be running out of options and turning to extreme measures to keep the economy afloat. At the end of the day, whether through bonds or these rumored printing presses, the approach is still deceptive and just a short-term fix. And there's a good reason why Putin and his cronies are hiding these acts from the public in this way. As you can imagine, openly admitting to randomly creating money could cause panic. If Russians knew their rubles were being made without real value behind them, they might stop trusting the currency. People could start hoarding dollars or goods, and businesses might pull back. Knowing that their life savings would lose value overnight would cause a riot, and a loss of confidence could tank the economy fast. By using bonds and bank loans, it looks like regular business, not a desperate move. But the signs are clear. Inflation is at 9.4% this year, even with the central bank hiking interest rates to 21% earlier this year to slow it down. They cut rates to 18% in July, hoping prices were stabilizing, but that's still pretty high. The bond trick buys time, but it's like patching a sinking boat with tape. The water's still coming in, and the fix won't last forever. In fact, the government is so worried about people finding out the truth that they have gone so far as to increasingly restrict access to core government statistics, including economic, demographic, and crime data, as concerns grow over a potential economic slowdown. Unfortunately, for anyone who cares about the Russian economy, Putin can't stop himself from making more money. Why? Well, the war is the primary reason. It's a machine that needs constant cash to keep moving. Soldiers need salaries, equipment needs replacing, and supplies must keep rolling. The 2025 defense budget is enormous, and without this money, it would collapse. Cutting back risks losing ground in Ukraine, where every inch gained costs billions. Right now, the conflict is a brutal slog, with small advances requiring more troops and gear. Estimates suggest Russia is spending $1 to $2 billion a month just on frontline operations. Stopping the cash would mean soldiers go unpaid, tanks sit idle, and the whole effort stalls. That's not just a military loss, it's a political disaster. Putin built his image on strength and resilience. Admitting the war can't go on would crack that image, and he's not ready to risk it. So, the money keeps flowing, even if it means digging a deeper economic hole. It's not far-fetched to say that Putin's pride is costing the future of the Russian economy. But the war isn't just draining resources on the battlefield, it's reshaping life at home as well. The government uses this money to fund subsidies, raise wages in key sectors, and boost pensions. Currently, labor shortages are severe as 2.6 million workers are missing, with projections of up to 11 million short by 2030 if the trend continues. To keep staff, companies are forced to raise wages, which drives up costs. In early August, the government also announced a modest pension increase for working retirees. But with inflation surging, it barely makes a dent. The government brags about low unemployment, officially under 3%, but that's misleading. Many workers are in the military, and others have left Russia, with over 1 million having immigrated since 2022. Without this extra cash, salaries and pensions might get cut, and that could spark anger. For now, it's about making sure people don't feel the economy's full pain. But it's a fragile balance, and the cracks are starting to show in everyday life. Politically, this is about staying in power. Putin's grip depends on people believing he's got everything under control. If he cuts spending, regions could see more salary delays or pension cuts, and that risks protests. In places like Siberia and the Far East, unpaid teachers and doctors are already waiting weeks for paychecks, with delays tripling since 2024. Small protests have popped up, mostly over local budget cuts, but they're a warning. If people start feeling squeezed too hard, those could grow. It's part of why he can't stop printing. This artificially created money keeps the system running, creating a sense of stability, even if the reality is pretty shaky. Putin is selling a story of resilience, saying Russia is beating sanctions and thriving. But the truth is messier, and keeping up this illusion is a big reason the money keeps flowing. But keeping people calm comes at a cost. When the government floods the economy with cash to fund wages and pensions, it triggers another problem: inflation. You see, when you add money to an economy without more goods like food, clothes, or fuel, prices climb. That effect is being seen in real time as everyday Russian items are getting pricier. A loaf of bread that cost 50 rubles in 2024 is now 60 or more, and cereals are up 15% in some regions. For basics like potatoes and butter, it feels higher, especially in rural regions. In the Far East, some stores are short on milk and butter, echoing Soviet-era shortages. The government's talking about price controls, setting caps on what stores can charge for staples. That might sound helpful, but it often backfires. Stores won't sell at a loss. They just stop stocking items, leaving shelves empty. They would rather not sell than lose money. Countries that tried this while creating money, like Venezuela, ended up with worse shortages. Russia's not there yet, but these are early warning signs. We'll dive into a case study on those countries later in the video, so you can see exactly how Russia's path is doomed. Inflation isn't the only pressure squeezing households, though. The ruble itself is losing value, and that's making everyday life harder. Early on in the year, it was strong, trading at about 70 to the dollar. But now it's slid to around 80, and some analysts say 90 or 100 isn't far off if oil stays low or sanctions tighten. A weaker ruble means imports cost more. Think medicines, electronics, or food from places like China or India. Russia still imports 30% of its medical supplies, and those prices are climbing. For the government, a weak ruble helps a bit since oil sales in dollars turn into more rubles, but for regular people, it's all bad. Higher prices hit stores, and families stretch budgets to cover groceries or bills. The central bank's high interest rates, even after dropping, makes loans and mortgages expensive. A small business loan might cost 20% interest, choking growth. It's a tough choice. High rates slow inflation, but hurts businesses, while lower rates risk prices spiraling. Again, all of this economic turbulence is starting to show up in daily life, and for many Russians, the strain is becoming impossible to ignore. But as ordinary Russians struggle, some are doing just fine. That's because corruption is quietly siphoning off the cash meant to help. You see, when money flows through murky deals like bond sales, it's easy for some to pocket the cash. Russia's seen this before. In the 1990s, bailout funds meant to save banks ended up with insiders. Today, elites close to the Kremlin or running big companies are likely benefiting. Anti-corruption cases are up. Over 5,000 opened in 2025, including high-profile ones like former Deputy Defense Minister Timur Ivanov, sentenced to 13 years for embezzling 4.1 billion rubles. Sadly, these are likely just the tip. The system lets a few profit, while most Russians pay the price. This wastes money meant for the war or public needs, like fixing hospitals or paying teachers. It also fuels resentment. When people see prices rising but no real improvement, they notice the gap between what's promised and what's delivered. That's dangerous in a country where loyalty to the government is key. Speaking of loyalty, another reason why Putin will keep creating money out of thin air is to secure the loyalty of these elites and oligarchs. To survive politically, he needs to buy time and secure loyalty, and right now that loyalty comes at a rising price. Russian elites and oligarchs form the backbone of Putin's power structure. These are the men who control key sectors such as oil, gas, finance, construction, and mining. Many of them became billionaires through their connections to the Kremlin, but their loyalty isn't based on ideology, it's based on benefits. They stay loyal if they continue making money. If that flow of wealth dries up, the foundation begins to shake. Sanctions have already cut many of them off from Western banks, seized their yachts, froze their real estate, and blocked access to foreign assets. Business is tougher, profits are shrinking, and their global lifestyles have taken a hit. As the war grinds on, the cost of staying loyal becomes harder to justify. This is where printing money becomes a political tool. The Kremlin uses it to keep state contracts flowing, fund inflated defense budgets, and subsidize the industries controlled by powerful allies. It's not about rescuing the broader Russian economy, It's about making sure the most influential players don't turn on the man who holds everything together. Even if the ruble weakens and inflation rises, as long as the oligarchs are paid and their businesses survive, they have fewer reasons to challenge the status quo. But there are signs of unrest. Some oligarchs have started expressing frustration with the direction of the war and its economic consequences. A few have made subtle, carefully worded criticisms. Others are relocating their families and moving assets to safer countries. There have even been quiet reports and leaks suggesting that some among the elite are looking for a way out, not just from the economy, but from Putin himself. And that is the true danger. If enough of the elite decide that Putin is no longer the safest bet, the pressure could start to build from inside. Putin understands this risk. That's why he's doing whatever it takes to maintain control. He would rather flood the economy with rubles than allow his grip on power to loosen. He is willing to sacrifice economic stability to keep the military funded, the security services loyal, and the oligarchs satisfied. In Putin's Russia, preserving political power comes before preserving economic health. If printing trillions is what it takes to delay betrayal and prevent a palace coup, he will do it. The long-term consequences for the Russian economy are secondary to him. The real question is how long the strategy can hold, and whether anyone close to him will have the courage to bring it to an end before everything collapses. And crazy enough, if past cases are any indication, it might not be so long before that happens. When it comes to matters of printing money or creating money, history doesn't whisper, it screams. We've seen what happens when governments reach for the money printer as a quick fix to deep structural problems. Take Zimbabwe between 2007 and 2008. The country was already reeling from years of economic mismanagement, corruption, and international sanctions. But when the government coffers ran dry, the Reserve Bank simply printed more Zimbabwean dollars to paper over the crisis. At first, it looked like a temporary solution, but then prices started doubling every single day. People had to carry sacks of cash to buy a loaf of bread. A $100 trillion note couldn't buy a loaf. The economy spiraled into total dysfunction, and by 2009, the Zimbabwean dollar was dead. With inflation at over 200 million%, people lost faith in the currency entirely. It was abandoned and replaced by US dollars and South African rand, just to keep commerce alive. The fallout wasn't limited to money. It led to widespread hunger, unemployment soaring past 80%, and a humanitarian crisis that forced millions to flee as refugees. Zimbabwe's GDP shrank by over 40% in that period, turning a once promising economy into a cautionary tale of how unchecked money creation destroys trust and stability from the ground up. Venezuela's descent followed a similar pattern. Beginning in the mid-2010s, the collapse of oil prices in 2014 drained the country's primary income stream. Instead of cutting spending or reforming the system, the Maduro government ramped up the printing presses. Inflation exploded. First, it hit triple digits, then climbed into the thousands. Shelves emptied. Hospitals ran out of medicine. Crime soared. Over 7 million people fled the country. One of South America's richest oil nations became a case study of how quickly things can fall apart when a currency loses its meaning. Black markets thrived as people bartered for basics, and the bolivar became worthless, with hyperinflation peaking at over 1 million% in 2018. The government's attempts at price controls only worsened shortages, as producers halted operations rather than selling at a loss, leading to empty supermarkets and long lines for subsidized food. Social unrest boiled over into massive protests, met with crackdowns that deepened the divide between the regime and the people. Russia isn't there yet. Inflation still sits officially under 10%, and the country is still exporting oil and gas. It still has trade partners, especially in Asia, but the warning signs are multiplying, and when trouble strikes, it comes hard and fast. The ruble has lost much of its value since the war began. Prices are rising steadily, and the central bank is depleting its reserves to maintain stability. Quietly, the Russian government has begun issuing massive amounts of domestic debt, and the central bank is now a key buyer. In plain terms, they're printing rubles to plug growing holes, and that's where all these other countries started from. What makes Russia's case more dangerous than Zimbabwe's or Venezuela's is scale. This isn't a small country on the margins of global finance. This is a nuclear power with over 140 million people, major cities, and global entanglements. If inflation takes off, if confidence in the ruble breaks, or if sanctions keep tightening the noose, the impact won't be contained. The economic fallout could ripple across borders, drive up energy prices, destabilize neighbors, and send financial shockwaves far beyond Moscow. For instance, a sudden drop in Russian oil output could spike global crude prices by 10 to 20%, affecting everything from gas pumps in Europe to manufacturing costs in Asia. Neighboring countries like Kazakhstan and Belarus, reliant on Russian trade, might face their own currency devaluations or supply chain disruptions. The playbook is familiar. Ignore the fundamentals, print money to stay afloat, and delay the consequences until they can't be ignored. The only question now is how long Russia can keep this balancing act going before it tips over. At this point, you might be thinking, well, many countries have printed money before, so what's the problem? What sets Russia apart from, say, the US or the EU? After all, post-2008 financial crisis, both added trillions to their economies through quantitative easing. The US Federal Reserve bought bonds, much like Russia's central bank, but inflation stayed low, around 2%. Why was that? It was because of trust and transparency. People believed the dollar and the euro would hold value because those systems are open, with clear rules, independent courts, and free markets. Central banks explained their moves, and markets trusted they'd pull back if needed. Russia lacks that completely. Sanctions isolate it, and the government's tight control over information erodes trust. If people doubt the ruble, they might hoard goods or dollars, worsening inflation. The central bank calls this targeted support, but with reserves at 160 billion and deficits at 2.2 trillion rubles, the margin for error is small. The 1990s ruble crash, when savings vanished, still haunts Russians, and that memory could spark panic if trust fades. The consequences of Russia's economic strategy don't stop at its borders. What happens inside the country could ripple far beyond. A weaker Russia might initially seem like a win for its rivals, but it's not really that simple. Economic strain could force Moscow to scale back its global footprint, especially in places like Syria or Africa, where it has spent billions on military operations and influence campaigns. While Russia has already redeployed some forces from Syria to focus on Ukraine, it still maintains a presence there. In Africa, its influence is even growing, with private military contractors now operating more directly under the Russian state. But desperation might also trigger more aggressive behavior. Moscow could escalate in Ukraine, stir up instability in the Baltics, or intensify cyber attacks on Western infrastructure. Russia's nuclear arsenal and military capabilities still make it a force that can't be ignored. If internal pressures mount, Putin might lash out externally to rally support at home, potentially drawing in NATO allies or disrupting global shipping routes like those in the Black Sea. If the economy collapses further, it could spark internal unrest, protests, elite rivalries, or even challenges to Putin's grip on power. Those regional breakaways are unlikely in the short term. A deeply fractured Russia could become unstable in ways that worry its neighbors, especially those like Poland and Finland. Trade partners like China would also be affected. China now buys roughly 40% of Russia's oil exports, up from around 20% before the war. But this relationship is not based on loyalty. If Russia's economy deteriorates, China could demand deeper discounts or more control over joint projects. The same goes for India and Turkey. They'll trade with Russia, but always on their own terms. For example, India has been paying in rupees, leaving Russia with currency it struggles to spend effectively, which adds another layer of inefficiency to these deals. A weaker Russia could also send shockwaves through global markets. If oil exports fall sharply, global energy prices could spike, affecting countries from the United States to Japan. The fallout from Russia's economic crisis would not stay within its borders. Take the potential for refugee flows. If living conditions worsen, more Russians might seek asylum in Europe, straining resources in places like Germany or the Baltic states. Or consider commodity markets. Russia supplies key metals like nickel and palladium, and disruptions could raise costs for electric vehicles worldwide, slowing the green energy transition. That global ripple is already reshaping trade. As Russia turns away from the West, it's scrambling to build new economic lifelines. Sanctions forced Russia to pivot from Europe to Asia, but it's not seamless. China now takes 50% of Russia's exports, up from 30% in 2021, but they demand steep discounts. India buys more oil but pays in rupees, which Russia struggles to spend. Turkey's trade is up 20% since 2022, but it's mostly low-value goods. These deals keep some cash flowing, as Russia earned $100 billion from non-Western trade in 2024, but it's not enough to replace lost Western markets. Sanctions also block high-tech imports like semiconductors, which Russia needs for weapons and industry. Domestic production covers only 30% of tech needs, and workarounds through countries like Kazakhstan are slow and costly. This trade scramble shows Russia's resilience, but also its limits. New partners help, but they can't fully replace the old system. The pivot has led to uneven benefits, with some sectors like agriculture gaining from Asian demand, while manufacturing suffers from part shortages, further widening inequalities within Russia. Putin's strategy isn't designed to win peace or prosperity, it's designed to survive a collapse. Every policy, every printed ruble, every sacrifice of long-term stability is made in service of one goal: holding on. But no regime can outmaneuver gravity forever. The danger is not just that Russia is drifting towards crisis, it's that no one inside the Kremlin seems willing or able to change course. Every lever that could soften the blow is being used to delay it instead. And that makes the eventual impact more violent, more unpredictable. The buildup of debt, the erosion of reserves, and the strain on the workforce all point to a tipping point where small triggers, like another oil price dip or a failed harvest, could accelerate the downfall. When that moment comes, it will not look like a dramatic explosion. It will arrive quietly, then all at once. A market freeze, a run on the banks, a silent mutiny, a televised speech that signals things have gone too far. It will not just be the economy that collapses. It will be the myth of control that has held Putin's system together for decades. And the world will not just be watching, it will be reacting. Realignments will begin. Old enemies will test their chances. Allies will reassess. The fallout will not be contained to Russia. It never is when great powers fall. This is the final cost of printing money to hold on to power. It does not just mortgage the economy, it mortgages the future. And as Russia's oil reserves continue to slide, the pressure only mounts, forcing even more reliance on this risky path.